It's there. Yeah, it's okay. Good evening, friends, and thank you very much for this opportunity. It's a privilege to address this gathering. And let me share with you, actually the previous session was very interesting. I am sure all of us would have probably preferred continuity of that, but let me now share with you some thoughts about India's economy and the market's outlook. So this is the progress of India over the last 40 years. And the first two columns give you the real growth. And what you will see in that in the last 20 years, the growth rates of India have moved up compared to the previous two decades. And this improvement in growth is a function of two things. One, the opening of the economy in early 90s, and second, the maturing of the IT sector that provided both the foreign exchange to the country and also large number of jobs. As you opened up the country, the inflation has come down. You can see in last 20 years, inflation has averaged around 6%. Because you opened up the supply side, you increased competition both locally and from imports. The rupee GDP growth of the economy has been more or less constant around 13 to 14%. And that is what equities have done in India. Over long periods, equities have delivered around 14-15% CAGR. And the reason of that is this, that our economy in rupee terms has grown around 14%. Sensex started in 1979 at a value of 100 and today it is 60,000. It is up 600 times. There is a very simple logic to this. If something grows at 14%, it doubles every 5 years. If you look at this period from 79 till now, it is roughly 45 years. If you divide 45 years in periods of 5 years each, you will get 9. So that means the economy has doubled roughly 9 times in last 45 years. And if you double 100 9 times, you will get 51,200. So the Sensex is essentially doing what the underlying economy is doing over the long term. And that's why equities are a good long-term investment in the Indian context always. The good news in India is that the real growth outlook of India, I think, is the best ever that I have seen in my career. And there are two main reasons why I think the economic growth in India should further accelerate. And this is the first thought on that. A typical person earns, spends and saves the maximum in the working age group. So the more the number of people in a country in the working age group, the faster the economy grows, provided your social politics, all of that is stable. Look at here what is happening to US, Europe, Japan, China and India. Other than India, none of these large countries or areas are experiencing a growing working age population. It is only India which will continue to grow the working age population till 2050. And most others are experiencing a declining working age population. So there will be a shortage of working age people in these large economies of the world. And in COVID, what has happened, work from home, remote working has become acceptable. And therefore, I feel a lot of jobs in India, in non-IT, IT offshoring we have heard of, but in areas like accounts, taxation, back office, legal work, transcripts, designing, R&D, whatever can be done remotely has a good chance of being offshored to India. So I think in the service industry, where remote working is now acceptable, this demographics, growing working age population at a time when large countries in the world are shrinking in working age population, I think will create a very large number of jobs and it will lead to an acceleration in the growth rates of the economy. The second reason why India's growth is likely to accelerate is that we are likely to increase our share of manufacturing as well at a faster pace. If you look at the history of manufacturing, Europe was first to industrialize about 200 years back. And in last 200 years, manufacturing has moved from Europe to US to Japan to Korea to Southeast Asia, and in last 20 years to China in a big way. So I feel what has happened, whichever countries have stable political, economic, social situations, and where wages are low, manufacturing moves there in search of lower costs. And now I think it is India's turn. If you look at the chart in the middle and you look at the manufacturing wages in India, China, Thailand, Vietnam and Cambodia, you will find Indian wages are half of Chinese and Thai wages and roughly the same as Vietnam and Cambodia. Our rate of wage growth has been the lowest in last 10 years. Vietnam is up 4 times, Cambodia is up probably 3 times, China is more than 2x, because India did not participate in the manufacturing outsourcing thus far. But today, when our costs are extremely low, I think the economic logic of the time has come when India will be able to gain its share in manufacturing faster. Also in COVID, what has happened, the risk of single country dependence in manufacturing has been highlighted. So the world wants to adopt China plus one, and geopolitically also, I think the world would like to reduce its over-dependence on the Chinese manufacturing. So I think the time is right for India to accelerate its market share gains in manufacturing as well. If you look at the chart on the right, the blue line, India has moved up from 0% of exports manufactured market share to 2.5% presently. So we have gained about 0.1% market share every year. I think time has come when this share gain should accelerate. Manufacturing is a much bigger opportunity. Just 0.5% of global manufacturing is 110 billion US, which is roughly the same size as IT exports. But unlike IT or offshoring of services, manufacturing shifts take much longer because it takes 3-5 years to shift a factory, whereas you can shift 1,000 jobs in services in just about 6 months. So I think this manufacturing will take time to really accelerate, but this should aid a lot of economic activity, job creation for a few decades to come. So when I look back, I find that India is probably the only country in modern history to experience an acceleration in market share gains in both services and manufacturing at the same time. And both of these should create huge economic activity, large number of jobs, and that is why I feel the 6% growth of last 2 decades should further accelerate to 7 or 8%. This is a very simple slide, it should take 5 seconds. This presents to you the low penetration of discretionary consumption, goods and services in India. You will find India's car, AC and airline tickets sold per person are 1/5 to 1/20th of China and US. They are a fraction. So which means if we are able to provide jobs, consumption presents a very large, significant growing opportunity. So net, I feel that the economic outlook, growth of India is actually quite robust, and compared to the 6% growth that we have seen in the last 2 decades, I think the next 2 decades we should be able to grow 7 or 8%. Finally, coming to the markets, if you look at the last 2 columns, they give you the returns of the Sensex, and you will see the last 2 decades returns of the Sensex are very close to the rupee GDP growth of the economy in the last 2 decades. So while economic outlook is extremely promising, the long-term outlook of Sensex is also promising. What is also clear is that the Sensex is not behind the economic growth. It has kept pace with the economic growth. So therefore, I feel that chances of valuations moving up are quite limited, and bulk of the future returns should come by way of earnings, by way of the growth of the underlying economy. So I think it looks like that 12 to 14% long-term returns is possible in the Indian markets. What is the risk to Indian markets is basically one. See, we know that in COVID, US dropped interest rates to nearly 0, and lot of money was injected in the economy. And you can see here the top two lines, that's the size of the Fed in the ECB balance sheet. So they have gone up very sharply. So a lot of money was pumped into the system. And as things come back to normalcy, as inflation is running above target levels, I think the world is experiencing a rising cost of capital, and also these Fed balance sheets, the central bank balance sheets in US and Europe size will be brought down. And when liquidity is being removed, it is never good for asset prices. So I think this is a small risk in the near term. So near term outlook for markets, while it is always very uncertain, I feel this is a risk that one should not ignore. But slightly longer term, I think India is probably the best growth prospects it has ever had. In my opinion, the next 2 decades should be that. So thank you very much. That was a brief comment, and I'm sure you have a few questions. So I thought I'll leave some time for Q&A. So extremely happy to answer any questions. Thank you. Yes, please.
Good evening. Just my question is that the RBI has increased the repo rates gradually since a year, just to control. Probably maybe the base reason is the control to the tussle of the inflation. And in the last monetary policy, in the bi-monthly monetary policy, that 35 basis point has increased. So whatever liquidity, excess liquidity was there in the near term or short term, as you mentioned, but they pumped earlier in the COVID pandemic time, it was now mostly it is getting now sucked in. So, and also the accommodative stance also they have changed from accommodative to hawkish stance. So during the very recent development that still COVID may come back or COVID is still there. So do you think that again RBI will come back to the window stem phase, or what will be the corrective measure they will be going to take to as a control or as a measure, whatever you think. So that's just what is your view?
See, I don't know the future and no one knows. And equity markets, we are dealing with uncertainty. And short term in equity markets is always uncertain. And I will give you a simple example. While most of us are interested in forecasting the markets near term, it is, I think, quite difficult. And look at it this, every share that trades, there is a buyer and there is a seller. So for the same company, same time, same price, unless two different opinions meet, the share does not trade. So one of the buyer or the seller is always typically wrong. So the short answer to your question is, I don't know what lies in the immediate future. But I think the relation between small variations in cost of capital and long-term equity market returns is a very small one. The big correlation of equity market returns is with the underlying growth, and that is what you can see here. The nominal GDP growth is what basically reflecting in the long-term returns of the Sensex. So I agree with you that the near term there are uncertainties regarding cost of capital. Both in India, bank deposit rates are going up because credit growth is faster than deposit growth. Globally, cost of capital is going up. So these are some challenges near term, but equities are always a volatile and a risky asset class in the near term. But longer term, I think the market outlook is reasonable. Yes.
Thank you.
So just as a normal investor, you are quite different because you are managing a full fund. So what should be your advice to an investor that they should focus as similarly what the fund manager looks at? As you said that we don't predict the market. So whatever you are investing as a fund manager, you are taking a long-term prospect. But should an investor also should follow the same pattern to gain from the market, or how did he project that whether he should move ahead, should he liquidate, should he churn his profits in this scenario in COVID also, or in coming developments in the Indian economy? So what should be the prospect?
See, in India, we are fortunate that we are part of a rapidly growing and a large economy. And therefore, the long-term prospects of equities are extremely encouraging. 100 Sensex has become 60,000 in 44 years at 14% CAGR. If you had earned 7 or 8%, this money would have been maybe 2,000. So that is the power of compounding. An extra 5-7% return over long periods, over a lifetime, it becomes a very, very large number. So I think the biggest difference to our long-term wealth is made by asset allocation. What portion of your wealth you are investing in the 6 to 8% fixed income asset class, and what portion we are investing in the 12 to 14% equity asset class. So I think we should all focus on asset allocation. Most of us, we focus most of our energies on timing or security selection because we are always looking for quick returns and we forget the power of compounding. So I would urge you to arrive at your asset allocation very carefully. Maintain a diversified equities portfolio. You can either do through mutual funds or you can do on your own. There's chartered accountants, all very smart, informed people. So either both options are open. But how much to invest in equities? I think the key is your tolerance for volatility. So whatever is anyone's wealth, whatever portion of your wealth you don't need for next 5-10 years, and on which you can tolerate volatility both emotionally and financially, that much you should invest in equities. And trust me, equities over long periods will create so much wealth for you, which is hard to appreciate even today. But the journey of Sensex, 100 becomes 60,000 over 40 years, 45 years, gives you idea of the potential of equities. So I would say that we should not underestimate, we should not underinvest, get your asset allocation right, but please do maintain diversified portfolios all along. Thank you.
Thank you, sir.
Yes, please. So that's what I showed you. If you add real growth plus inflation, it is between 13 and 14%.
Going forward, what do you expect?
I made a case that the real growth will move up
by
by maybe 1-2%. That's what I said, that offshoring of services and manufacturing market share gains, this 6% growth should further move up to 7 to 8%.
okay. Right.
Yeah.
Thank you.
So good evening, sir. So can you please elaborate what is really a diversified portfolio you mean?
Pardon?
Diversified portfolio. What do you mean exactly by that?
See, there are two types of risks in stock markets. One is the whole stock market can go down, like it happened in COVID. And that risk you cannot diversify. There is a second risk which is specific to a business. If steel prices go down, the steel business suffers. If interest rates go up sharply, the demand for cars may come down. If currency depreciates sharply, it is good for software, it may be bad for the automobile industry. So individual businesses, industries have specific risks to themselves. So these are risks which diversification can reduce substantially. And that is the purpose of diversification, that invest across sectors, across businesses, so that the diversifiable risk, the business specific, the sector specific risk can reduce. If you do not diversify, 100 will become 200 or 100 will become 50. So then you are not compounding. It tantamounts to taking huge amount of risk and it can start bordering on lucky draws or speculation. So a sensible way to invest in equities is to always remain effectively diversified across 5, 7, 10 sectors.
So can I ask which sector looks good to you next 2-3 years?
So in India, almost all sectors will grow because we are a growing economy. All sectors are under penetrated. We will gain share in export of services, in export of manufacturing. But I think two sectors where valuations are slightly below longer term averages still or are in line are, I think, banks and the power sector.
Thank you, sir.
Hello. Namaskar, sir.
Yes.
Sir, as we have seen that rising interest rate are always undermining the equity valuation, as you have also yourself explained just now. So, taking the current regime where we are seeing interest rate hardening, the cost of money going up, is it signaling to underperformance of equity going ahead? Since you are yourself telling that over a period of time, equity will outperform. So,
See, it is like this. If interest rates move up, if fair P moves down, it may impact returns for 1 year. If you buy something at 20p and cost of capital moves up and fair P is, let's say, now 16 or 17. So what will happen? After 1 year, the P will come down to 17. So you may not make money for 1 year, or you may make slightly lower returns than earnings growth. So that's what I said, that the correlation between small changes in cost of capital and long-term returns is extremely less, because long-term returns are mostly driven by the business growth, and change in PE multiples can impact 10-20% of the returns. Let's look at this way. If in 10 years earnings become 4 times, theoretically, so fair value goes up 4 times. Let's say the cost of capital goes up, so fair PE drops 10%. So instead of 4, you will make 3.6 times. So it impacts 10% of the returns and vice versa. But longer term, the correlation is with growth of the underlying business, and to a small extent, there is impact of the change in cost of capital.
So, sir, with rising interest rate also growth it can supplement growth. We
Of
have not
course.
seen it earlier, sir.
100 Sensex has become 60,000. So many times interest rates have gone up, so many times they have come down.
Yeah.
Yeah, myself, CA Dilip Doshi. My question is, what is your opinion on technology sector, considering the COVID impact and US recession? Right now, whether the valuation is reasonable?
I think valuations are slightly expensive, but bulk of large correction has already taken place. I think this is a very competitive sector. India is a global leader, and recession can impact it for small periods. But longer term, recessionary conditions increase the pressure on companies to cut costs. So actually it helps offshoring even more. So I think this sector is a very high quality growing sector. Multiples are slightly high for my comfort, but I still think if one invests over 3-5 years, some returns are possible. But ideally, one should wait for some more correction.
Okay, thank you.
Thank you so much. Thank you.